Hello and welcome to a fresh new edition of Bazaar Morning Call. I am Prashant. With me, my colleagues Sonia and Nigel. Good morning, guys.
Hi, morning.
Who watched the World Cup, the first game yesterday?
I watched a bit of it, yeah.
Bit of it?
I did.
Oh, me too. For the first half. Actually, the first half.
Missed out. I was focusing on the steel news. I was the one who was sounding about a fantastic Friday. I think I got paid back 11 p.m.
You had a fantastic Friday, but then Saturday onwards, you had to do some work,
Absolutely. Right? Hardworking one.
All right. I mean, I think steel, of course, is going to be the top talking point for the most of the session today. Absolutely, no two ways about it. But let me just quickly tell you the two or three things which will make a difference. One is, of course, the fact that oil prices are down sharply. Actually, not just WTI, but Brent oil prices from the highs in November, from the 4th of November, are down 16%. That is 1/6. That's big. Right? But on the other hand, right, so this is a positive, but on the other hand, you've got global momentum. The rally which we saw in the US and Asia, that is starting to fade. Momentum is stalling a little bit. So I think you got this oil positive, but at the same time, macros are starting to turn a little bit. We highlighted this on Friday as well. So these are the two kind of opposing forces which will pull the market in either direction. The SGX Nifty is indicating about a near 100-point cut now, so 0.5%, 18,253. The telltale signs were there on Friday, on Thursday, and we've been highlighting that. So maybe a bit of pullback, at least the word go. This morning is what we're expecting. Good morning, guys.
Hi, morning. And, there's a sell-off that you're seeing across the board. I mean, you spoke about the commodity market sell-off, right?
Yeah.
The crude.
Yeah.
There are, of course, demand concerns there as well. It bodes well for our own markets, but largely it's a sell-off that you're looking at globally. The SGX Nifty is under pressure. Asian markets are looking quite weak this morning as well. And the US futures are also indicating that the start over there could be in the red. So given all of this, just look at Hang Seng. It's down over 500 points right now. Given all of this, our markets, the start will, of course, be in the red. That is the expectation today. However, you had the Dow, which was in the green on Friday. So mixed cues over there. It was a 200-point rally that you saw. FIIs have been selling a bit in our own market. So 750 crores is what you saw as a sale, while DIs bought about 900 odd crores. The thing is, there are no major global or local cues to look at over the course of the next fortnight. And as we head into the end of the year, generally the cues are lighter. So there's no major directional call that's taken. The US markets will be closed on Thursday for Thanksgiving. They will shut early on Friday. So towards the end of the week, you won't get many global cues as well. The Nifty, though, is facing resistance at that 18,400 mark. And given the way we're going to start today, looks like that could be a bit of a top for the market, at least for the trading day. A couple of cues that I'm watching out for. There's the RBI policy meet that takes place on the 5th of December. There's the Fed minutes on Wednesday and the ECB minutes on Thursday. But looks like this could be a market where, the global headwinds are something that could perhaps keep a lid on the gains, and this 18,400 could be a bit of a resistance.
Looks like it. Let me start with the positive before I get to the negative. And oil is the positive, isn't it? So oil prices were down 13% last week, 16%, as I said, from the recent peak. So that is a big positive for a large oil importer like India. One cannot emphasize enough how, such a big relief it gets, right? The other thing is, and I'm highlighting WTI because it's more prominent, these structures are more prominent on WTI, but if WTI follows through on some of these price patterns, Brent will as well. So WTI closed below 80.8. If it closes below 80.87, it would suggest a fall towards the 200-week moving average. The 200-week moving average is far away, $64 odd a barrel, $65 a barrel. So it's poised in a way which indicates further fall. We'll see. The big worry is basically demand. Now, that gets me to the negative as well, right? On the other side, the other side of the coin. Take a look at some of these price changes. Simple, last week, what happened? We were expecting momentum to continue, but equities actually, by the end of the week, were flat. S&P 500, Friday to Friday, was down 0.7%. Rates were up. The 2-year, the front end of the absolute front end of the yield curve was up 19 basis points Friday to Friday. You've got the dollar, which was going down. It did not break the 200-day moving average, and it actually ended higher by about 0.5%. Friday, it was actually broadly up. Volumes were low, but it was up. and you got the Fed's terminal rate, which is back at about 5.1%. And that is why I'm saying is the momentum, the risk-on momentum that we've been seeing in global markets starting to stall a little bit, and you should pay attention. So how are we set up? You got, as I said, signs as we head into this week in the US that maybe things are slowing down a bit on the upside. There is a holiday as well, Thanksgiving holiday in the US, so that will impact volumes. There are FOMC minutes on Wednesday. Expect them to be hawkish. But, I mean, we've heard so many Fed speakers, and at the margin, it's not made that much of a difference. Then in India, you've been seeing, and we've been highlighting this, that if you just read the screen, there has been signs of profit taking, especially in mid caps and small caps, right? I mean, pockets of mid caps and small caps have corrected quite a bit. Price damage has been significant, even though it doesn't show up on the Nifty. But it has been. So on the Nifty, we saw a 100-point bounce from the exactly 100-point bounce from the low on Friday, which was 18,209. We left off at about 18,310 or so in the last hour of trade. So that kind of becomes the pivotal kind of level. The point is, even as we kind of eye new highs, which are still not very far away, keep an eye on the downsides as well. And if you're trying to buy the dip up in, I think these are levels you could at least test and use. So 18,209, which is about 100 points from where we left off, perhaps important that it holds. Bank Nifty has got a swing low, which was around 41,965, which should hold as well. Bank Nifty also has been showing signs of, it's not been able to get out of this range for the last 4 or 5 sessions, so we'll see how it goes. SX is indicating a slightly lower start, 0.5% or so. I would say give it time, give it the first hour, see the texture of the market, and then decide whether you want to go in, buy the dip. The dip got bought late into the session on Friday. We'll see if that repeats itself. Nigel, what are you watching?
Well, the Hang Seng market is in a bit of a tizzy, right? But the Nifty has actually underperformed the Hang Seng. That's been moving up one way. It's up 20% in this month itself, but the Nifty is up, not too much. Year-to-date chart, if you look at the Shanghai market as well as the Hang Seng market. So we have underperformed actually those markets. So them pulling back, I'm not too worried about that. What's good for us is a couple of cues. One is that the crude oil prices, they have dipped down. So that's been, fairly, that's a positive cue for us. Dollar index as well, that's more or less held steady, which is also good news. So those two are the big global cues for me. Friday session, if you chase the gap up, you didn't make money. If you bought the dip, you would be making a lot of money. Today, this morning, you're going to be getting the dip. So that buy on dip thesis is going to be tested yet again. The FIs in the F&O market, they continue to remain net long. They unwound some long as well as short positioning. Remember, we're getting into expiry week. In the next 3 sessions, it'll be the end of the November series, so volatility will pick up as well. What's telling you that at higher levels, you like to see some resistance is the way they're writing calls. Even in Friday session, the FIs wrote 2 calls for every 1 put, and we saw aggressive writing at around that 18,400 call. Take a look at the open interest build up. The 18,400 call, there was more than 50 lakh shares added out there. The total open interest is closer to around 1 crore shares, and the premium is around 80 rupees. So that's telling you that there is writing. There'll be a resistance at around that 18,500 odd mark. The 18,300 call as well, premium around 130 to 150 rupees. So 18,450 becomes a bit of a resistance. However, on the downside, the 18,300 put that continues to see open interest build up, plug in the premium out there. The stop loss comes in at around 18,210, 18,220 odd. So the range is set 18,100 to 18,500. In terms of closer levels, 18,210 is from where we bounced off on Friday. So that's last week's low, which becomes a support. On the upside, we took a U-turn from around 18,458. So that becomes a bit of a resistance zone. An 80-90 point downtick, if we get that, risk reward could favor the bulls at around that 18,200 mark. Sonia, what?
Okay, so let's see how it shapes up. For starters, at least we're headed for a red start. And as you said, there's resistance at higher levels. And global cues not looking that great either. Just a couple of more things. There are 2 listings today. There's Archean Chemical Industries and 5-Star Business Finance that list today. And out of the 2, I think Archean is expected to be a good listing, considering that it saw over 32 times subscription. It is the largest exporter of bromine. It's into this, manufacturing of industrial salt as well. And compared to peers, it's not a bad, valuation that Archean is trading at. So I'm going with a positive listing over there. The muted one debut could be from 5-Star Business Finance. There are a lot of issues that it's facing, including competition, etc. But even the subscription levels were not too great for 5-Star Business Finance. So just keep your eye out on these two debutants on the Lal Street today. But plenty to talk about. First up, we have a call coming in from Rhythm Desai of Morgan Stanley, who says that Q2 earnings were a beat despite weak margins. The consensus FY23 numbers remain above their top-down numbers despite broad negative revisions and broad market earnings outperform. Rhythm also says earnings cycle is intact at the moment.
Well, we also have another view coming in from Citi's Robert Buckland. He says hopes of China reopening have boosted Asia ex-Japan equity. Citi is overweight MSCI China on the potential boost to depressed EPS. They prefer Taiwan to Korea, though both markets should see EPS contract from here. According to Citi, India looks expensive, but justifiably so. They remain neutral, but would look to rebuild and overweight in India as the excitement elsewhere fizzles out.
Okay, it's important to track the money markets as well. It's there's been a lot of movement in the commodity and the currency space. So on the rupee, here's what you can expect. B. Prasanna of ICICI Bank says, after unwinding of speculative long positions, the dollar is finding some base held by hawkish comments from Fed members. According to Prasanna, the rupee has underperformed this recent dollar weakness owing to dollar demand from oil companies and the RBI. This week, with flash PMI data and the FOMC minutes in sight, he expects the dollar to be range-bound and the rupee to trade between 81.25 to 82.25 against the dollar.
Well, on the bonds, B. Prasanna says global yields drifted higher post continued hawkish comments from the Fed members. However, crude prices are not able to sustain at high levels. Given dim demand outlook in Indian markets, bonds remain range-bound by regular supply, but overweight index swap or OIS may rally further given expectations of RBI being less hawkish. He expects a 10-year benchmark yield to trade in between 7.2 to 7.4% range.
Well, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at the iron and steel stocks, like Tata Steel, JSW Steel, JSPL, SAIL, NMDC, Aarti Industries, Deepak Fertilizers, RSI Magnesita, Escorts, Cyient, Tata Motors, and Delivery. They are stocks on the back of positive news flow. While we have Auto Pharma and Dr. Reddy's, well, they are stocks that are likely to open up in the red.
All right, Mark Matthews is with us of Bank Julius Baer and Company. Mark, great to have you with us here. Thank you very much for your time. Appreciate it. You know, I don't know if you saw that sort of quote from Robert Buckland of Citi. Interesting way to put it. He said, well, right now, because the market in India has done much better than other markets, there's a bit of excitement elsewhere. But he's saying that positioning-wise, he would wait for excitement elsewhere to fizzle out before starting to build up an overweight here in India. I don't know if you have any thoughts around that, Mark, before we get to kind of the here and now.
Well, that seems sensible to me, but we're already overweight India. We've been so for well over a year, and we would like to remain so. Of course, there's this great debate over North Asia versus South Asia, and the debate is largely in favor of North Asia because it's massively underperformed South Asia. If you include the currency declines in countries like Japan and Korea, you truly do have distressed prices. And I was interested to see Berkshire Hathaway taking a stake of over $4 billion in Taiwan Semiconductor. They announced that last week. Those North Asian markets are heavily cyclical plays. They're basically plays on the global economy. And you might think it's odd to want to buy a semiconductor company if the chances of a recession in America are high next year. We put the chance at about 40% right now of a recession happening in America. But I suppose that the markets have already priced that in because, as I said, they have underperformed so much this year. Anyway, on balance, we still stick with India because it's not a proxy for the global economy. It's a proxy for its own economy. And its own economy is doing well, and we think it will continue to for a few more years. So despite the fact that it's expensive relative to the others, we're very happy keeping our overweight there.
All right, very happy keeping you overweight in the Indian market, and I'm sure Indian investors are happy as well. Given the kind of trajectory we've seen, we are virtually at all-time highs. Mark, but you did mention that there is a 40% chance of a recession in the US. If that does transpire, you think India will be completely insulated? If not, how does an investor approach it? Do you go all in now, or do you wait for getting better levels over the span of the next 6 months?
I think it would be quite well insulated, and the reason I say that is there's two things. The first is that foreign investors, as you would know, have not built up substantial overweight positions in India. Quite the converse, actually. And so that's a big difference between today and 2008. 2008, India, of course, went down a lot. But that's because foreigners had been buying it up for the last few years. And the second thing is, unlike 2008, if we do have a recession in the United States next year, I think it'll be a very shallow one. And on balance, enough that wouldn't really expect a lot more downside even in the S&P because it's already kind of priced a recession, a shallow recession in this year. And so if the S&P doesn't go into some terrible tailspin like it did in 2008, then I think people would be looking for greener pastures, and that would bring them to India. So even if there's a recession in the U.S., I think that India will be fine next year.
Hi, Mark. Good morning. Mark, what about what's going on in the cryptocurrency space? We haven't seen any ripple effect on the equity markets as of now, but that asset class has punctured many pockets. What's your sense?
Well, I'm very encouraged by the fact that we haven't seen the contagion that,
yes,
frankly, one would have expected, Nigel, because you may remember in the sell-off in June, the correlation with NASDAQ and crypto was about 0.9%, which is to say they were moving almost in lockstep with each other. I don't know why this time it's different, but I suppose that anecdotally, just the sense I have is that people who buy crypto, or I should say who bought crypto, went all in. That was their asset allocation. They were so, committed to the idea. And so I doubt they really had much equity exposure because all their big bets were in crypto. That's the only way I could explain why we haven't seen the contagion effect this time.
Mark, dramatic fall in oil prices, right? I mean, 13% last week, 16% from the highs in November. So this is, I mean, there's been no output changes from OPEC or any big sort of disruption, etc. This is just a panic on demand, right? Demand falling faster. How would you read this plunge in oil in relation to what, in terms of impact on equities? It's positive for macros for big importers like India, but how do you kind of read the rub-off on equities?
Positive, definitely. I mean, equities don't like a high oil price. By the way, we don't think that oil is going to go down a lot. We see it broadly in the $80 to $90 a barrel range over the next 12 months. But there's no doubt that oil going down is a benefit for almost every equity in the world, apart from the oil producers themselves and the few countries that are net oil exporters. But no, it's good for us. I don't know why it's going down. I guess there's an increased sense that there could be a recession in the United States next year. I really don't know.
All right, we'll leave it at that. Thanks a lot for joining in, Mark, and have a great week ahead. Thanks for being with us on CNBC TV18. So there is a 40% chance that the US could head into a recession. The macros are still a bit weak over there. But for the Indian markets, we're largely insulated. That's the word coming in. Let's slip into a quick break. Lots of stocks in focus. Our list of top stocks coming up in just minutes from now. Welcome back. Well, lots of stocks in focus, so without wasting any time, let's first talk about the big announcement that came in and the iron and steel companies that could be impacted because of this. Nigel, over to you.
Well, the government of India, they've rolled back some of those export duties that were levied in May 2022 itself. So the list should come up for you with the new revised rates. So let's focus on it bucket by bucket. Steel stocks, well, they in focus. Tata Steel, JSW Steel, JSPL and SAIL. Those are the large names out there. The positive is the avenue is opened out yet again. That's the export avenue. So inventories will not build up and they have some bit of an export avenue. However, on pricing, Jeffrey says that the domestic pricing is still at a premium in comparison to imported steel. So, on the pricing front, it's unlikely to move the needle too much. Stainless steel, JSL Stainless as well as the Hisar, both of them will be clear-cut beneficiaries. Remember, there's a power crisis in Europe. This is a tailwind, with the export duty coming off. So it opens up the export avenue yet again. Pellet producers, Godavari Power and Ispat, clear-cut, beneficiary out there. They used to export bulk of their pellets. Now they can do that yet again, and that fetches you a better premium out there. And remember, over the weekend, I think there's been some attempt to push up the prices as well. And finally, NMDC, they don't export iron ore, but if pellet prices are going to move up, then iron ore prices as well will move up. So the big beneficiaries will be Godavari Power and Ispat, JSL Stainless, as well as NMDC. For the ferrous stocks, they open up in the green, and let's see what they do from there.
All right, Nigel, thanks very much. That's a big story which we will get you more perspective on as the day goes on. But there's a very interesting deal in the chemical space as well. Aarti Industries and Deepak Fertilizers, and the agreement is on nitric acid. Sonal is here to tell us more. Sonal, hi, good morning.
Good morning, Prashant. Well, first the news, and as you rightly pointed out, it is between Aarti Industries and Deepak Fertilizers. It is a 20-year contract, a term sheet that these two companies have entered into, where Deepak Fertilizers will be supplying nitric acid to Aarti Industries, and term sheet is expected to be executed by end of this calendar year itself, that is 2022, and also the size of the contract is 8,000 crore rupees. Now, what does this mean for these two companies? For Aarti Industries, nitric acid is a big raw material, and for Deepak Fertilizers, it's one of their major products as well. In fact, Aarti Industries, in the last conversation that we had with them, told us that they are planning to set up a nitric acid plant, this in order to secure their supply side arrangements, and because nitric acid availability was not very strong, and because of the Russia crisis, prices of nitric acid had gone through the roof. Now this means that they will be able to secure supply of nitric acid, their backward integration plans that we need to know about. But for now, it is a positive for Aarti Industries because their supply side needs are taken care of, because they had been indicating that nitric acid availability is not at par with the previous levels.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm looking at RHI Magnesia. Well, over the weekend, they went ahead and they bought the non-core business of Dalmia Bharat. That's a refractory business out there. So they've gone for market share, but it's come at a price. Let's run you through the details. They are going to be issuing shares of close to around 27 million shares at a price of around 632. So the equity consideration will be around 1,700 crores. Add to that, they're taking on debt of around 450 crores. So approximately, it's around a 2,150 to around 2,200 crore enterprise value. And this is coming for a company that they're acquiring whose EBITDA for the last year was little less than 100 crores. So it's coming at an expensive valuation of around 22 times EV upon EBITDA. However, they're going for market share. So that's where we're going with green on this one. We'll hear from the management later on in the show as well. But Sonia, Escorts, why are we tracking that today?
So there was a midterm business plan that Escorts came out with on Friday post-market hours, and I think the stock is going to react positively, and the street might like it because there's some very aggressive guidance that the company has given out here. They talk about how the revenues will grow more than 2.5 times by FY28 over FY22, and their EBITDA margins from 10.8% in FY22 are expected to improve to mid-teens. They are looking to attain leadership in the India led by in the export business of India in terms of tractors, and even in the domestic tractor industry, they are looking at becoming a challenging brand versus a market share of 10.8% that they had in FY22. Now, how will all of these objectives be met? That will be met by expanding their capacity. So they're looking to expand capacity from 170,000 units all the way to 300,000 units, and the total capex that they have outlined is about 4,000 crores. Now, JP Morgan maintains an underweight. They say that they are very encouraged by the company's roadmap, but the stock has perhaps priced all of this in because the stock is now trading at 25 times FY24, and the strong growth, the good news looks like is in the price.
All right, Sonia, thanks very much for that. So that's Escorts for you. Now, Oro Pharma is going to be in focus. Ekta is here to tell us more. Why? Ekta, hi, good morning.
Thanks for that. Well, yes, definitely a little bit of bad news coming in for Aurobindo Pharma because their Unit 9 has been inspected by the US FDA and issued 10 observations by the US FDA already. Remember that this particular plant already had an official action indicated status, which is basically a negative status from the US FDA, increases the chances of any kind of regulatory action, which was issued in May 2019. After that, this was the first inspection, we understand, and then they were issued 10 observations. So it doesn't bode well. We don't know what the observations are. The company has said they're procedural. They do not relate to data integrity. But nonetheless, we could see a negative sentiment on Aurobindo.
Okay. All right. Thanks for that, Ekta. Hopping across to Rima. Rima, you're tracking Cyient?
Well, they held an analyst meet on Friday where the company provided insights on their strategy, business outlook, as well as the new growth area. In terms of numbers, the company reiterated their ambition of hitting $1 billion of revenue by FY24. It should happen in the second half of the year. They also reiterated their FY23 guidance, which stands at 13 to 14% in organic growth, plus an additional 14 to 15% in terms of acquisitions in constant currency terms. So they reiterated their guidance for FY23. But they also provided a lot of commentary on the new growth areas, particularly auto, healthcare. Now, these currently are about $15 to $30 million in size. But they're saying that in the next couple of years, these individual verticals can hit $100 billion. They also spoke a lot about the communications business, which according to them can actually get up to $250 million by FY24. And there will be a lot of acquisitions that the company will take in order for these verticals to grow in size. There was also an important update about one of their businesses, DLM. If you remember, the company had been guiding that, we want to monetize it in some form, part divestment, a part partnership perhaps, maybe even an IPO. All the company said in the conference call is that some update should happen, some concrete plan should happen by the end of this fiscal year. Back to you.
All right, Rima, thank you very much for that. More stocks with news flow. Vivek is here with that. Vivek, hi, good morning.
Well, good morning. A whole host of stocks in focus on the back of multiple changes as far as the indices are concerned. First on the list, of course, is the sensex change. So Tata Motors will come into the sensex effective December 18th at the expense of Dr. Reddy. Tata Motors is expected to see inflows of close to $150 million, while Dr. Reddy is expected to see outflows of close to $112 million. When you're talking about the FTSE, like we had indicated last week, Delivery has made an entry into the FTSE. This will be effective from December 16, 2022. Inflows of close to $8 million are expected into Delivery. Also keep in mind the lock-in period, the 6-month lock-in period for Delivery shares as far as Anchor Allotties ends today. So the stock will remain in focus on the back of that as well. Another update, this is a finalization of an earlier paper drafted by the NSE. The NSE had earlier, invited applications in terms of how exactly are participants expecting NSE to treat corporates or treat companies in indices on the back of corporate actions like mergers and acquisitions. So the NSE has now decided that the new rules indicate that the target will be deleted from the index 1 day prior to the X date. Now this, taken in context of the HDFC Bank merger, basically indicates that HDFC will now be deleted only 1 day prior to the X date, and the weight will be increased the next day.
All right, thanks a lot for that. So here's a quick recap in case you missed out on any of these stocks. Stocks with positive news flow. There are all the iron and steel stocks. There's Tata Steel, JSW Steel, JSPL, SAIL, NMDC, Aarti Industries, Deepak Fertilizers, RHI, Magnesia, Escort, Cyient, Tata Motors and Delivery, while stocks with negative news flow, Aurobindo Pharma and Dr. Reddy's Laboratories. But the big global headline is what's been happening in the world of crude. There's a massive slide that we've seen. There are demand concerns resuming once again. Of course, bodes well for oil importers like India. But Manisha Gupta is here to give us a quick roundup of what led to this steep fall in crude overnight. Manisha, over to you.
Thank you for that, Sonia. Well, yes, 10% of a decline in the previous week is what crude is dealing with, and we are trading at a 2-month lows right now. It has to do with the surge in COVID cases in China, and China also cutting not just the November deliveries, but the December loading volumes as well. So that tells you that the demand is not improving in the world's biggest importer there. The Europe supply concerns also seem to be easing as refiners are now have piled up stocks. And the markets also are looking at weak economic data continuing, not just from China, but the U.S. manufacturing activity in the month of October also was the lowest since 2011. So it is about increasing production from U.S., weak demand from not just Europe, but China as well, and enough supplies that the Europe is dealing with right now, all of that weighing on the chart.
Right. Thanks very much. Oil, of course, is a big positive for macros. Markets, though, in the short term, is that a cue that maybe demand is weakening faster than expected? And what's the rub-off? That one will have to wait and watch. But on the macros, unarguably, it's a positive. We'll take a quick break here. Up next, Ashish Kejriwal.
Well, the SGX is suggesting a bit of a pullback, but the big news that came over the weekend was about the pullback in the export duties that were levied in May 2022. In fact, CNBC-TV18's Tim C had given you a heads up in the final hour of trade on Friday, and a few hours later we got the official word coming in as well. But let's discuss that. We have an analyst who's joining in from Nuvoma Wealth Institutional Equities, actually, Ashish Kejriwal. Hi, Ashish. Good morning. Good to have you on CNBC-TV18. You have not spoken to us in a while, but let's speak about the impact of this. Tell us straight up, who are the biggest beneficiaries of this? Because we understand that it will help volumes, but pricing is unlikely to move. Your take?
Yeah, Nigel, good morning. Thanks for having me on the show. Yes, you rightly pointed out that this event is more of a, you can say, confidence building rather than numbers of grade. Reason being is that the duties which have been imposed in May 2022, the situation now has completely changed. And now the world market is not the same what it used to be. So as of now, if I'm looking at from the exports angle, it's still not possible to export HRC because export prices are much lower. That is, export prices are something like 13,000 rupees lower than if you're selling in the domestic market. So exports are not a viable option right now. The only benefit which happened is that this will help them to at least ease some pressure in selling in the domestic market. So that is the only positive thing. And unless until global prices recover, it's not possible for steel prices to increase in that fashion in the domestic market because we already are at a premium to landed cost of imports. So the material which is arriving right now, we are at a premium of something like 3,000 rupees. And the material which is about to arrive in Jan, we are at a premium of 9,000 rupees. So it's not possible for them to increase prices. So this is more of a mid to long-term positive rather than short-term positive as such in steel.
Sure.
But yes, stainless steel is different. Stainless steel is the biggest beneficiary for that because right now also if you are exporting stainless steel, it's positive for them. They can make money of it. So for me, for this duty withdrawal, Jindal Stainless will be the biggest beneficiary.
Okay, Jindal Stainless. But just coming back to the steel stocks, Ashish, as you mentioned, export prices are much lower, so exports are not a viable option right now. What is your view on how to approach the steel stocks itself, the Tata Steels of the world?
So, today's move could be different, but what we will suggest is one is to not go very, very aggressive in buying it because global market is still not that where we can buy and increase our shareholding in that. Okay. So for steel stocks, except for Jindal Steel and Power and Jindal Stainless, we are having our hold rating on all. And in the short term, so unless until global prices recover or China reopening happening, that will really fructify. I think it's better to book some profit in some of the large names like Tata Steel, JSW Steel, and JSPL should remain a buy on that.
Okay, all right. So Ashish, just to do a quick recap, JSPL is a standout one from the ferrous space. You like JSL Stainless from the stainless steel space, which is a clear-cut beneficiary. And maybe booking out of the other ferrous names could be a prudent strategy. Are we getting that correct?
Yes, but depends on what kind of price increase happened today.
Yes.
So if the stock prices increases beyond 8-10%, then that's a right strategy.
Okay, all right. What about NMDC? That's another beneficiary, right? It seemed the street was sniffing that. The numbers were absolutely disappointing in the second quarter, but it has seen some buying. What would you do with NMDC? Because pellet prices are going to move up. Iron ore prices as well could see a bit of an uptrend. And the price cut they took a few days ago, that could get reversed. So how do you approach the stock at around 110 rupees?
So that's a fair possibility which you pointed out, Nigel. But one has to keep in mind that iron ore, which is above 58% Fe grade, our calculations suggest that still it's not possible to export.
Okay.
So that means the supply of 58% plus Fe content iron ore, that will continue in the market. And if that is continuing, that means supply is already there. So unless and until steel prices increases, there is a possibility that iron ore prices may not increase in the same fashion in which pellet prices have increased.
Okay, and on this...
our sense...
Sure. Sorry, no, I just wanted a view on the stock itself at this 100 rupee price, 111 thereabouts. How does the risk reward look?
So our fair value is 121 only, and we are not changing that.
All right.
Because, right now it's not possible for NMDC also to increase prices in a hurry. And our sense is that pellet prices, which has increased on Saturday by around 1,000 and 1,100 rupees, they will also pull it back sometimes within this month.
All right. Thank you very much for joining us. Great speaking with you, and Ashish, and hope to see you back soon. A good conversation. Prakash Devan is with us as well. Prakash, good morning. Good to have you with us here. We start a new week. Comment on steel. If you've been listening into the conversation with Nigel there, what are your thoughts? And how is the market texture looking, Prakash? I mean, Are we starting to see a little bit of froth being taken off? The index may not show it, but we are seeing profit booking in broader markets.
Good morning, Prashant. So, on the steel names, I do agree. There's going to be definitely a lot of positivity in terms of the inventory management. None of these companies will now be saddled with a lot of stock, which probably was getting a bit uncompetitive in terms of price points and all. But it's something which, in terms of them getting to have improved realizations, they will have to look at least 2 quarters ahead in terms of making some meaningful sense out of that, because this is not something which you can just quickly ramp up production and start selling off, and the export prices anyways are not favorable at this point in time for you to make great money. The domestic demand is what's keeping a lot of these companies very positively buoyant, and if there is some sort of an indication from global reopening in terms of China particularly, making some sort of moves on normalizing it, beyond the COVID lockdown protocol, then probably things could probably look up. But if you actually go through, fine comb the entire steel sector, there's very small companies that could probably benefit. Maybe you could have a Godavari Power or maybe a Kirloskar Ferris because of the fact that now castings don't have any this thing. Pig iron duties have also got rationalized in that sense. So there's going to be definitely some sort of a percolation of the benefit, but it's not going to be very dramatic, is my view. In fact, there are some companies like there's a very decent company, not discussed much, but called Lloyd's Metals. Now they have enough mining assets and enough supply this thing arrangement which are already there. The demand is never been an issue with them. And they could probably, look at some sort of a rationalization on realization. So there will be these small tweaks, is what my guess is, Prashant. So that's it. On the market texture, I think it's evident we are, beyond earnings season. And what we are looking at is that the earnings season has been a mixed bag. There are certain sectors where there has been some disappointment, some concerns emerging. And those are the sectors where there's a little bit of rotation getting out from, So when you look at advanced decline, the reason why it doesn't give you the same buoyancy as the Nifty did, let's say, a week back, was because there are lots of churn that's happening from an inter-sector perspective. And my guess is that, whenever you are close to tops, there is a little bit of a hesitation to buy more, buy afresh. But, I think the way IT is kind of rebounding of sorts, or, even financials are kind of giving you that comfort of assurance, Cements making a comeback, you will start seeing some buying emerge. But probably, it's not happening immediately. People are still digesting the results, this thing. So that's the point. But, and these gap downs are the only time you could buy as a trader into the markets and make some money, given the texture of the market being so volatile. I mean, you get moves on both sides, but entry gets a bit difficult. But today's day, for example, is ideal for somebody to buy in and probably wait for the rest of the day to reward you. So it will be a very, very, what you call, short-term orientation for most people. Even positional calls, the timelines have shrunk. But fundamentally, I think the results season thrown enough opportunities for everybody to look at from a medium to longer term perspective, to buy into some new themes, new sectors that are emerging very strong.
I wanted your thoughts, Prakash, very quickly on escorts, because there's a very strong guidance that the company has given. A full roadmap has been laid out for the next couple of years. But the stock has also rallied a lot. At this price, is it still favorable for investors to go long?
Good morning, Sonia. So I think, that's the roadmap that you see is exactly what a Japanese player would think like. That's exactly why Kubota is in. They've taken time to settle and get their feet into the business and the market. And now they're very clearly looking at these segments where they would get into a little bit of a leadership mode in the next year, 2 years, 3 years. I think it's a great business model that's emerging. It's a great product profile, at least, that's emerging. But you will have to buy it on dips, and the market will give you dips in the auto side on any particular day where there's some sort of a news flow that probably is not so strong. And that's exactly when you buy. I mean, it has run up, so has M&M, but all these stocks will give you some opportunity to get in, and that's where you latch on to for the next couple of years. Given the roadmap gives you visibility of very good earnings this thing traction, which justify price levels, but maybe probably 8, 10, 20% lower from where we are.
Okay, well, just stay on. We have a quick corporate conversation that we have to complete. So, Prakash would urge you to listen into it. Alembic Pharma posted a better than estimated set of Q2 earnings. The company has seen their revenues rise 14% this quarter, led by the US business and the API business. And margins have also recovered on a sequential basis to nearly 16%. R.K. Baheti, the CFO at Alembic Pharma, joins us now with a quick call there. Mr. Baheti, good morning. Although your margins have recovered sequentially, they are nowhere close to the 27-30% that you used to see, pre-pandemic. I mean, in Q2 of FY21, for example, you were sitting at 30% margins. Now, of course, we don't expect it to come back to that anytime soon, but can you give us at least guidance on what the next couple of quarters could look like? If there is further recovery, then what could it be?
Yeah, sure. Thank you, Sonia. First of all, thanks to CNBC for hosting us. Sure. Your observations are very right. The margins are under pressure, primarily because US generic business is under pressure. And that's not for us only. That's almost for the entire industry, except the companies which have some strong specialty products. The entire generic industry is suffering price erosion in US, largely because of oversupply. So what we are attempting is to hold on to our market share, to realize as good a price as is possible, because we are never a volume changer. I mean, we have always kept profitability in mind. And Q2, of course, as we said in our investor call also, we had some couple of one-off opportunities that helped in improving margin. What is more satisfying to us from margin point of view is the domestic business is growing, and it's growing as per plans. So X of what we call COVID-related sales last year, we have grown a decent 11%. Specialty is growing faster than that. And we'll continue to outperform the market. I mean, we hope to continue to outperform the market in the domestic business. And that's a more stable business from margin perspective. Margins have also been under pressure because, we are writing off some of those older amortized cost of the company which we 100% acquired and merged with Alembic, which is Alior, which is a dermaceutical company. The business per se is good because we have already got some 20-odd approvals. A lot of them have been launched. But again, due to market pressure or pricing pressure, I think the margins are under pressure.
Mr. Baheti, good morning. So you briefly alluded to this one-time opportunity, right, which was there. And how much of the sales, US sales, were on account of that? And what will we see in Q3 on account of that?
Yeah, I mean, okay, we don't give product-wise details or breakup, but we have guided in the past, not guided, but we have generally indicated in the past that we'll be happy with about $45-50 million of revenue per quarter in US, for US only. And then, of course, Europe and Australia and other markets chip in. Like Sonia also observed, API business has done very well for us. Strong performance on back of very high growth numbers for last year also. So we are happy about the API business.
Mr. Baheti, good morning. The last time I think we were chatting, you were more like 50 to 55 million USD per quarter. Now you're talking about 45 to 50. Which way is it swinging?
So no, you are absolutely right, and most of it is to do with the price erosion. As I said, we have held on market share of most of our larger products. We have also introduced few more products, but price erosion is sort of negating all our positive efforts.
Understand that, and you spoke about how the generics business has been under pressure for a while. On an average, you used to do at one point about 500-600 crores of average revenues from the US generics business. In this quarter, that has come down to about 360 crores. What do you think the run rate could be? I mean, are you looking at a recovery to 400 crores, 450, or will it continue to be, subdued at these levels?
So X of US, because US is a very difficult market to predict in terms of growth, because whatever volume growth we do or new products we introduce, a significant portion of the growth number is determined by the prices which we realize for existing portfolio. So except that, I think the other rest of world generic business should see a growth of 12%, and API will continue to see a growth of at least 10%.
All right, Mr. Baite, we'll leave it there. So thank you very much, and hope the pricing pressures in the US abate. That's been the big worry for lots of companies, generic companies in that market. 6:25 on Alembic Pharma. We'll take a break here. We are sort of heading towards market opening, 14 minutes away. So Prakash, of course, is with us. We'll also be joined by Sudarshan and Mitesh with their technical setups this week and what trades they'd like you to take. Those conversations follow in just a bit. Okay, welcome back. There's 11 minutes to go for the pre-open session. Sudarshan Sukhani and Mitesh Thakkar are with us to set us up in terms of trade and individual names, etc. as well. Gentlemen, good morning. Great to have you back with us. Sudarshan, how are things looking? SGX is indicating a lower start, almost 85, 90 points. I mean, we were talking about this kind of fading of momentum last week as well. Although in the last hour on Friday, things came back, right? I mean, the Nifty bounced about 100 points. This morning, we will give most of it back. What's your sense?
Yeah, good morning, Prashant. My sense is that the market was in a trading range for the last 6 trading days, and that range is now on the verge of a breakdown or a breakout. This, trading ranges cannot last forever. They have to move out of, prices have to move out of that range, either on the upside or on the downside. The sense seems to be that if the Nifty is now willing to go through a break below the support level of 18,250, which means the trading range will resolve itself on the downside. That means we are looking at some kind of a dip or a minor correction. Once we get a sense that this is what's going to happen to the Nifty, it's best to step aside and wait for that minor dip or correction to be over. Now, this is not a change of trend, which means that the bull market is not changing into a bear market. What we are seeing is a pause. But the pause is not tradable on the short side, and there's no sense in buying when we expect prices to come down. So it's best to step aside and let this dip come and complete itself.
Okay, got that. Mitesh Thakkar is also with us. Mitesh, do you think this 18,400 mark could prove to be a resistance for a while, given what we're seeing globally, the volatility? And if yes, what's the strategy for today and for the week?
So my sense is that in the short term, yes. The idea is that the hourly indicators have kind of weakened with the Nifty failing to get past this 18,350-400 band in the last 3-4 days. So you will see some kind of profit booking and a consolidation happen before we have this trend to reattempt and try and get past these levels. So in the short term, I believe that you might see the Nifty consolidate, and the worst case scenario, 18,079.80 band could be tested. But I think we are still not looking at a change of trend on the downside. So the uptrend remains, but this could be a consolidative contracting kind of a market wherein you will see some choppiness and volatility, but within a range.
Okay, morning Mitesh, morning Sudarshan. Mitesh, give us some of your stock trading picks.
Yeah. So I have a mix of buy and sell calls today, Nigel. Good morning. Buy on Honeywell Automation with a stop at 4,500 for targets of 42,200, and a buy on Power Finance Corporation with a stop at 121 for targets of 134. On the sell side is a couple of pharma names. Laureus Labs is a sell with a stop at 458 for a target of 432. And Cipla is a sell with a stop at 1114 for targets of 1,070.
And Sudarshan, how about you?
Well, again, it's a mix. Maruti is an intraday short. Maruti has been falling consistently for a few days, not participated in any rally recently. There's a stop at 9,024, so consider that as a stop loss and go for an intraday short. NMDC is a buying opportunity. I think it has showing relative strength as well as some rise in momentum. It's a buy with a stop under 106. Titan is another short sell. Short selling should be done only intraday. It's an intraday short with a stop above 25.80. Like the earlier stock, Maruti, Titan is also falling steadily for many days now, underperforming. And ICICI Bank is a buy. Now here I must tell you that don't go and rush and buy ICICI Bank. It's not going to go against the Nifty. But if you sense that the markets are stabilizing, then banks will become the first buying opportunity. And ICICI Bank is first amongst them. stop under 900, consider buying on stability.
Okay, all right. Well, thanks a lot for that. So those are a lot of, technical cues for you to watch out for. But now that earnings season is behind us, we have kick-started or restarted our segment Momentumizers, where we talk about a lot of stocks that have some momentum going for themselves, either on the volume, on the price charts, or any, fundamental news as well. And Nigel's going to begin. And Nigel, what do you have?
Well, India Bulls Real Estate, it was feeling the momentum on Friday. The stock ended at the high point of the day. And if you're looking at the share price, well, there was a very, very strong close that we saw in Friday's session itself. So it's a long way away from the 52-week high that we saw exactly a year or so ago. But otherwise, the close was very, very good and on very, very high volumes. From the lows as well as seen a good bit of a bounce. Technically, it closed at a very strong level. It's conquered all the technical levels. In fact, it closed above the 200 DMA after a while. So that was positive, around the 200 DMA. So a strong closing as well. And the delivery volumes were massive, more than 70 lakh shares on the NSE. On an average, it was close to around 25 lakh shares, so nearly around 3 times of what we've seen. And this was the highest delivery that we've seen on the stock in a single day in the last 3 months or so. So because of all these factors, we're looking at it. And today, there's an important trigger. There's that pending merger with the Embassy Group. Well, the NCLT Chandigarh, will be hearing that. So that is the final trigger out there. I went through the presentation, and it's mentioned that today there's a hearing on that front. So keep an eye out on the stock, moving with momentum, solid delivery as well. So we'll have to track this one, Sonia.
Okay, we'll track India Bulls Real Estate had a good move on Friday. But do we have Prakash Diwan with us? Maybe we can squeeze in a quick question. Prakash, the other stock I wanted to ask you about, and it's what's flashing on the ticker now, is the amount of resignations that we're seeing at Zomato. I mean, this is the third resignation in the last 1 month and high-level exit at that. What do you do with the stock now?
So, interestingly, if you look at the kind of exits that we've heard of, including the last one, Mohit Gupta's exit. So Mohit Gupta was classified as a founder much later than the business started. In fact, he was brought in from his stint at Make My Trip just a few years back, actually, to drive the operational scale up of the business. And some of the other exits have been on areas which are slightly peripheral to the operational matrices of the company. And what seems like happening is that the company itself has let go or shed a lot of weight on some of the newer businesses, and this could probably be a fallout of some dissonance that is created. But if you look at the core business, I think it's probably never been as good as it is today, Sonia. To be honest, it's kind of improving fairly dramatically on revenue accretion and on the kind of the consciousness to make profits rather than just to kind of keep on getting into the market to increase market share and presence. So somewhere I think it's a tipping point. This could end up being probably a time from where the company starts throwing up the right kind of revenue, the right kind of bottom lines, which people are desperately looking for to justify these valuations. But having said that, I think the entire overhang of the selling pressure that used to be there from people who had probably thought they made the wrong choices is over. So I think the stock will probably be very resilient and only improve from here on. But I'm not recommending this to the faint-hearted because this could still swing either side on the back of news flow. But it looks like all the damage that has had to be done is being adjusted and priced into the stock at this point in time. And it could probably have an improvement phase starting from here, which could be laborious, but will definitely be distinctly on its way up.
I mean, sometimes these things can act as a positive catalyst as well. So it's not, and I think that's the sentiment that Prakash is echoing as well, without going into details of what the situation is. Unless, of course, I mean, there are there is some talk of wrongdoing, etc., and resignations because of that. But that's not the case here. And so we'll see. But I would sort of tend to agree with Prakash's view on Zomato. But there are more these relatively newly listed companies from the digital space we'd like to discuss, delivery, etc. as well. Take that quick break. We are back with a pre-open. And we'll also have the management of Aarti Industries to discuss their agreement with Deepak Fertilizers. That's going to be an interesting conversation you don't want to miss. We'll be back with that in a bit.